Hi, my name is Hunter Coziera, and I will be serving as the moderator of today's webinar featuring Bob Rubin, founder and president of Rubin Wealth Advisors, and Bill Flaig, founder and CEO of the American Conservative Values ETF, ticker symbol ACVF. So the purpose of today's webinar is for educational purposes, and we look forward to learning more about Rubin Wealth Advisors and ACVF. Introducing our panelists, we have Bob Rubin, the founder and president of Rubin Wealth Advisors, a wealth management firm that is driven by conservative principles and dedicated to the success of their clients. RWA has over 140 years of combined experience on their investment committee and a total of 180 million in assets under management or advisement. Bob Rubin is a frequent guest on national television, commenting about the current state of the economy, and he has been featured in magazines and newspapers such as Fortune, the Daily Caller, the Washington Times, Town Hall, and many other outlets. Thank you for joining us, Bob.
Thank you for having me.
Our second panelist is Bill Flaig. He is the CEO and founder of ACVF, the first ETF created for politically conservative investors, and he is a proven investment professional with over 30 years of extensive investment management and trading experience. Bill established Ridgeline Research in 2016 along with his partner, Tom Carter. Ridgeline Research is an investment advisor dedicated to creating investment solutions for politically conservative investors. Its inaugural and flagship product is the American Conservative Values ETF, which was launched in October of 2020. Thank you for joining us, Bill.
Happy to be here.
All right, let's get started. So for our first question, I'm going to come to Bob. Bob, why was it important for you to find a values-aligned ETF like ACVF instead of using a traditional index fund like the S&P 500?
Good question. Thank you, Hunter. I guess it's because the American Conservative Value Fund, ACVF, it allows me to stay true to both performance and principles. Its performance is tracked within 99% of the S&P 500 over virtually any time period since its inception. So I don't have to sacrifice returns. And just as important, I don't have to compromise on values. Traditional index funds continue to support companies that push progressive agendas like DEI, diversity, equity, inclusion, CRT, critical race theory, and ESG, environmental, societal, and governance. All of which these themes reject merit and market-based outcomes in favor of political activism. These frameworks may be dressed up as social responsibility, but they undermine capitalism and reward ideology over excellence. My clients want to make money. So in these funds, what they do is they hurt performance of the very companies you're investing in. With ACVF, I get broad, large cap growth U.S. equity exposure without endorsing that direction. I don't have to do that. I can invest client money and my own in a way that reflects our values, pro-capitalism, pro-merit, pro-freedom, while still aiming for strong long-term results.
That's really a powerful perspective, Bob, combining both performance with principle, and that brings us to the source. Bill, can you take us back to the beginning? What inspired you to launch the American Conservative Values ETF?
It was frustration, simply that we saw our dollars and other conservative dollars being used to support companies actively working against our values. Traditional funds, as Bob said, were rewarding corporate activism that silenced free speech, attacked the Second Amendment, pushed negative agendas, liberal agendas, woke agendas, under the guise of social responsibility. So we created ACVF using our extensive experience as our way to fight back, to give conservatives a voice in the marketplace, even more importantly, to educate them that they are begrudgingly or willingly, unknowingly investing in the liberal woke agenda. Give them a voice in the marketplace. We don't just talk about boycotting, we divest and we reallocate the capital that we would be using in these companies to companies that are, shareholder focused, maximizing shareholder value.
Can I jump in there, Hunter? I'd like to ask Bill a question. What are some of the companies that are, say, your largest boycotts? Your biggest companies that you're boycotting?
Yeah, so if we just go right now, we're boycotting in total 38 large cap companies. It's about 30% of the S&P 500, so 30 cents of every dollar that an investor might have in a traditional fund. By size, our largest boycotts are Apple, Meta, Amazon, and Google. I'd say by passion, the boycotts that most align with conversations we're having with politically conservative people over the last 4 years are Disney, Target, BlackRock, which is an investment manager really pushing the liberal woke agenda. If people aren't familiar with it, Nike, Starbucks, and then J.P. Morgan, which is a big bank, big DEI pusher in the past.
Cool,
Wow.
thanks.
Clearly, there's, real conviction behind ACVF's mission. Bob, what kind of feedback do you get from your clients when they see ACVF in their portfolios?
Well, I think the clients, honestly, they're relieved. So many of them come to us frustrated with the direction that this country is going. I mean, obviously, Trump has helped, but they just realized that from a financial standpoint, like what Bill just mentioned, a lot of these companies don't care, and there's a lot more of them that continue to push this woke agenda. And so they're even more frustrated that their money's being used to push that agenda. They don't want that to happen. So when they learn about ACVF, it's kind of like a light bulb goes off. They don't have to choose between financial returns and their beliefs. We can give them both. I've had clients say, finally, someone is standing up for us in the financial world. That kind of emotional connection with a fund is unusual.
Like you said, that kind of emotional connection to an investment is rare and it speaks to trust. Bill, let's talk about how you earn that trust. How do you determine which companies to exclude from the ACVF portfolio?
Yeah, thank you. Great question. So our investment thesis is that, as we touched upon earlier, that politically active companies are not maximizing shareholder return. So our methodology in practice is both values driven and risk aware. So we evaluate companies based on how aggressively they're pushing political activism, which has multiple dimensions. Particularly DEI, which I'd say is in the last 6 months really come to the forefront. Subcomponent of ESG overreach. Anti-free speech behavior has been one of our biggest concerns from day one. Suppression of conservative voices and services. Direct funding, direct dollar funding of left-wing causes or, giving them political support. We call them most hostile companies to conservative values. But we're thinking long term. These companies are misallocating their capital and ultimately creating reputational risk. And that's bad for investors. So we exclude them and we replace them with companies, as I said earlier, focused on profitability and politically neutral.
So with that values-based filter in place, let's kind of shift gears to application. Bob, how do you use ACVF within your portfolios? Is it a replacement or more of a complement?
So for many of our clients, me included for that, ACVF is a direct replacement for the S&P 500. You said you're getting broad U.S. equity exposure without the ideological baggage. And the performance, ACF is tracked within 99% of the S&P 500 over any time period since inception. So whether you go 30 days, 90 days, 180, year, 3 years, 5 years, 7 years, whatever, it's within 99%. So that's data. It's not an opinion. These are real numbers. So no, you don't have to sacrifice performance while you're doing the right things. I think in some cases, I do use it as a satellite position for clients who want a value-based aligned carve-out. But either way, it's a powerful differentiator. Clients understand it immediately, and they appreciate that they're putting their values front and center. I actually would like to ask Bill a direct question. Do you submit direct shareholder proposals to try to actually get these companies to do real changes, to like stop doing actual DEI or CRT or any of the crazy things that they do?
Yes, we believe that the economic power of boycotts is ultimately the best tool to affect change in the short term. I mean, if a stock goes down 30%, you're looking at a new CEO. whereas the shareholder process is more of
Good
a way to
point.
raise awareness of a concern regarding the company's activities. And it's very rare that even the lefty proposals get more than 5% of shareholder votes. So it's it's a difficult road to make change, but it's definitely worthwhile endeavor. So over the years, for the companies that we do own that we're concerned of, I mean, just because we own a company doesn't mean it's an endorsement of them, not being politically active. We own for performance reasons and risk reasons. So these companies that we are most concerned about that we do hold, we do submit shareholder proposals. They generally line up with the concerns of the fund in the first place. But a cost benefit analysis of DEI was one of the very first ones we submitted after we launched. Let's see some numbers. Let's see some data why DEI is good for these companies. I doubt it, but maybe it's good. Maybe they could build that case. But once they have numbers, then it's easy to rip their case apart as well. Recently this year, we've had something interesting happen with one of our shareholder proposals to Airbnb. We were concerned that they were going to use their code of standards to work against conservatives. They actually have denied service to a couple of conservatives based on the dubious claims of being politically extreme and things of that nature. So Airbnb, they just ignored, they just never responded to our proposal. Same thing happened to Heritage Foundation. Our proposals were ignored, lost by the mailroom, whereas Connecticut Retirement Fund, which had a liberal proposal, did make it to Airbnb's ballot. So with Heritage Foundation, we were actually just starting a lawsuit against Airbnb. So that's kind of taking our fight to the third level. We've got the boycotts, we've got the shareholder proposals, and now we're involved in a lawsuit, something I never would have envisioned when we launched, because this company has just blatantly disregarded these proposals.
Interesting. Thank you.
And Bill, some people assume that excluding, major companies hurts performance. Has that been the case at all for ACVF?
Well, that's, this is a great question and a valid concern, right? Nobody wants to, well, I wouldn't say nobody, but the vast majority of people don't want to lose money, miss out on making money, even if it aligns with their principle. I think some people say they will, and then if they, lose money, well, maybe a different story. So this is where our track record's important. We've got, over 4 years of performance at this point. And as Bob said, we've, very broadly performed in line with the S&P 500 while avoiding these companies. And, we're not claiming to say that we're going to outperform the S&P 500. We're just trying to be in line with it, be that replacement. So ultimately, avoiding companies that are hostile to conservative values, when you remove them, remember they're misallocating capital, you reduce risk. And that's not really just a values-based decision. That's smart investing. I mean, if you can reduce risk without sacrificing return, you'll always be in a better place. And this focus on long-term performance and protecting capital from the reputational regulatory risk resulting from corporate activism, it's playing out just the way we planned it, so to speak. We're very pleased with the result to date.
Awesome. So Bob, what would you say to other advisors who agree with this approach but haven't made the leap from traditional funds?
Well, I guess I'd say sitting on the sidelines is no longer neutral. Every day you keep clients in some of these legacy index funds, you're helping fund the very ideologies that both you and your clients are trying to escape. I'm not saying you can or should make 100% of your client portfolios politically conservative. I mean, first of all, it's not possible. It's not practical. It's not a good idea. And it's kind of somewhat hypocritical, as you would be doing the same thing that progressives are doing and looking for political activism instead of profits. We're looking for profits. We're looking to make money for our clients. And, maybe at the totality of a portfolio, you can take out 10 or 15% total of the wokeness out of the portfolio, but you can't completely eliminate wokeness out of it. And listen, these HR departments are staffed with crazy woke young people who just they have ideological fervor, revolutionary fervor that they want to change corporate America. So we're doing our best to push back on some of these companies. All I'm really saying is that you can replace the S&P 500 with ACVF and not lose performance. No, it doesn't cover small cap, it doesn't cover mid cap, it doesn't cover international. But otherwise, ACF makes it easy to offer an alternative or one that's aligned with high quality, competitive, and performance. So if you believe what your clients believe in, this is something that you should consider doing.
Those are definitely some strong words and a clear call to action. Bill, let's wrap up by looking ahead. What's in store for ACVF in 2025 and beyond?
Yeah, well, I think it's going to be an exciting time, especially with the Trump presidency, really pushing back on a lot of the negative corporate behavior we're seeing. I mean, they're probably just going quiet. It might not be a long-term change or sincere, the changes that the companies are making. And then just going back to where one of my earlier questions, why we started this, and it was frustration, as I said, but I think it was also, what Bob just said, kind of charged this. It was also, I felt, a moral imperative to do something about it. I had the tools, I had the investment knowledge. I was at a point in my life where I could build a startup company to do this. So it was a moral imperative that compelled me to do it, and I just wanted to share that. But we're focused on expanding awareness. Still, more people have not heard about ACVF than have. I think when they hear about it, they seriously consider it. They like what they hear. But expanding awareness, distribution, which is kind of an industry term, but that's advisor partnerships like with Bob. We are actually happily finding more and more advisors who are building their business around serving conservatives, which is great. We're happy to be involved with them and support them any way we can. Broader platform access, which again is kind of like industry jargon for availability of more brokerage firms. The bigger firms, they're harder to get on their platform. Continuing to refine our screening methodology. The issues that compel conservatives are ever changing. I'd say recently we're seeing more of a Buy America type desire out there in the marketplace, and we're trying to evolve that into our decision making as well, if we continue to see that. And we're exploring additional strategies, value aligned strategies that are kind of complementary to this large cap product and complementary to it in an investor's portfolio. But the mission remains the same. We're helping conservative investors grow their wealth without compromising their principles. And we've got some momentum, and we're going to accelerate it and continue to grow.
Hey, Hunter, can I throw a question in before you to wrap up? Bill said something that got me thinking. So I had said during my last answer that roughly 10 or 15% or so is sort of appropriate for ACF to be in a sort of a balanced portfolio. Like, you're going to have large cap, small cap, mid cap, international, some specialty stuff and all that. Now, what are your thoughts on that, Bill, as far as like what percentage of ACF in a portfolio is appropriate?
It's a good question, and I do get this question, and I don't want to be disingenuous and throw out a really high number, but it's where it goes is large cap, which is generally the biggest part of large cap U.S. equities, which generally is one of the biggest components of a person's portfolio. I wouldn't advise replacing more than half of that position with ACVF. I think it'd also be appropriate to maybe over time, new dollars coming into the portfolio, invest in ACVF. But I think, most portfolios position, 2.5%, 5%. You're not really moving the needle with that. So, something above 5% to maybe a maximum of half of the large cap exposure. Does that make sense?
Yeah, yeah. And actually, it's funny. Now we're thinking of these more questions here. Is that when we talk about that ACVS is tracked within 99% of the S&P over any of the time periods since you've been in inception, since you've started, that means net of fees, right? And yet your fees are, because people are always asking about fees, right? Your fees are higher than a typical S&P index fund, which might have 5, 2, 4, 5, 10 basis points, right? 0.02% or 0.1% of a percentage point. And yet you have a 75 basis point or 0.75% fee. And yet you still seem to get the same rate of return. So the client gets the same net results, even though they're paying a higher fee. You want to maybe address that a little bit, because people are probably concerned about it, yet at the same time, isn't it at the end of the day, it's what you keep that matters more than what you're paying, right?
Yeah, I mean, that's a great question. I was glad you brought it up, and I was hoping we could dig into it, because fees always come up. I'd say when I speak to people, their biggest objection is the fees. They just see, 75 basis points, and they're, looking for, 5 or 10. Well, when we launched the fund, and we looked at the market, the competitive landscape, 75 basis points for, a thematic, or more customized portfolio, was in line with that value proposition. So when we launched, we felt the 75 basis points was justified just for, not having exposure to these companies. And as things have played out in the last 4 years, yeah, you're absolutely right. So when we say we're in line with the S&P 500, we've kind of earned back that difference in fees each year to be able to accomplish that. So it is probably more relevant to look at performance after fees than to just fixate on the fees. But it's an important due diligence question. I'd say, we have had people who just can't get over that number. Won't look at the performance, as validation for the fees or the value proposition. And that's unfortunate. And the other thing, in the industry in general, these funds that have hundreds of billions of dollars in them, they didn't start off at 10 basis points. They started off with much higher fees. And then as they've grown, the economies of scale, they're able to lower their fees. So, that is I'd like to hope is in our future, with a lot of growth, that once we achieve economies of scale, we can lower our fees as well. But I think that's some time off, but that's the way it works in the industry.
But just, I want to clarify, when you talk about greater returns, that means it's net of the fee, correct?
Yes, like the performance on our fact sheets, or if you look on, Morningstar online, that's what you see is, the fee comes out of the fund every day. So that's net of fees.
Okay, thank you. Sorry, Hunter, thought it was a good question to ask.
Well, unfortunately, that is all the time we have for today. I want to thank both of our panelists, Bob and Bill, for their time today and sharing their expertise with the audience. We look forward to doing another webinar like this in the future. And for those interested in learning more about Rubin Wealth Advisors and ACVF, click the links in the description of this video to learn more. Thank you guys and have a great day.
Thank you.
Thank you, Hunter. Thank you, Bob.
All right, we're done. Let me stop the recording. Stop.